Hi, thanks for tuning in to our Practical Nerds weekly podcast. I'm Shub, and together with my partner and co-host Patric, we normally invest in founders in design, construction, renovation, and logistics technology. Many of our friends in the ecosystem wanted us to start a podcast on the built world, and in return, we decided to honor their request with a show about nothing at all. Hey, Patric, good to be back with you, sir, after, again, a short break. And it feels like I keep saying this more often.
Yeah, we've been traveling a bit, you and I, for the past 2.5 weeks, starting the year a bit different than normal, I guess. But now we're back into the rhythm, and I think we have a cool topic.
Yeah. I think, look, I think it's hard to say that there's any such thing as a normal time when it comes to, I guess, the world of startups, VCs, or in general, any time at all. It feels like I think we're living in all sorts of, a time where all sorts of crazy things are happening in any case, if you check what's being reported these days. But I think you had an interesting take, Patric, on how this relates to how to approach venture as a profession and how to select businesses that are worth backing.
So I posted this week about substance investing versus momentum investing using the tremendous round that Waymo just announced, with Sequoia and other investors chipping in 16 billion funding on a 126 billion post money for a business that does 350 million in annualized revenue, which is transactional revenue, non-recurring revenue. And so that's basically a 300 revenue multiple on a forward annualized non-recurring revenue, which is, I think no one can say that multiple is because of the today's substance, because then it would be a 5x. But it was clearly a momentum investment. So we're not going to discuss that. However, it did give me a few reminders of, hey, over the last 15 years, we have seen boom-style investments, which Waymo I would not count into. So the only thing is the Waymo round triggered my memory.
Mm-hmm.
Waymo does not fall into boom for me because this is actually, I think, a very good company. However, there are investments that the VC crowd and also the founders themselves are doing in very boom-style phases. There are always fads, there are always trends. VC is great at always picking the next narrative and then overfunding it and then creating overcrowded categories with too much customer buying choice. So here is the theme for today, Shub, and we have 5 examples just to remind ourselves. The theme is, if your startup business only works in times of boom, it's a shit business. That's the theme. So I bet anyone listening right now that has spent years in venture immediately has an example coming to mind. And the fascinating thing is, when you and I created a quick list, we felt like, oh my God, this list could be so much longer. There would be so many more categories and examples, but we're going to stick to 5, and anyone will have their examples in mind, and I think they demonstrate that. If your business only works in times of boom, it's a shit business. Let me take it off. Shub with the first example. So actually, you and I, we thought about, hey, what was the 2010 version of it? And then we were like, oh, but 2010, there was still so much GFC recession. Was it really that there was anything booming? Let me tell you, yes, there was, Shub. It was basically the whole point of e-commerce and loading that up with venture money to fund growth, fund rapid fire consumer expansion through e-commerce. And the example that we have is actually Groupon. So Groupon is a company that allowed individual users to, originally the idea was only to facilitate group buying in order to access cheaper deals in either the vicinity or later also nationwide. And then actually from there, it morphed into something more general, which was not group buying anymore, but it was basically daily deals. So it allowed local retailers as much as nationwide retailers, although it had a strong local component to it, to advertise on the Groupon platform, hey, today get a massage 30% off. And so through Groupon, I could discover these deals hyper-locally, also nationwide, and then basically make sense of that. The group buying aspect got a little bit into the background, although it was, I believe, always a component of it, but mostly it was daily deals. Shub, how did Groupon end?
Not well. I think it went public, but eventually eroded to I think only 3% of the value at which it listed publicly. Patrick, I think the other interesting aspect, right, and it's a coincidence. I think a couple of weeks ago, I was doing some reading on an entirely different company, and actually, what is a company called Coupang over in South Korea, often described as the Amazon of Korea.
Okay.
And when I was, reading up on like a deep dive into that business, so the founder actually also started a. I promise I'll bring this tangent back home. So the founder actually started the business as a Groupon of Korea, and they were actually on the verge of IPOing on that story, but they chose to eventually change the model entirely. And you know what the insight was? The insight was when you do a group buying model, the vast majority of customers are unhappy. They feel like they were coerced into buying or making that purchase because they felt a sense of peer pressure or a sense of discount led pressure, and they were lulled into it in the moment, but they never seemed happy with the purchase. So there was never a reason for them to come back and want to buy it, do another transaction again. And I think that also explains why, in at least the limited research I did across other markets, I have not seen like a Groupon like model succeed in markets. Now, there's newer versions of that, which, for example, in markets like China have done quite well with very different categories of goods implemented in a very different form to what Groupon does. But for the most part, the original Groupon model has not really taken off in other markets, because it also seems to be, my interpretation seems like a one-shot interpretation of how business is done, and it treats transactions as a one-shot game, which is perhaps also what the VCs back then thought it represented.
So now let me actually add the financing perspective of this to Groupon and the category as a whole, because Groupon is just a placeholder here for an armada of peers and clones that were also funded. So Groupon raised 1.6 billion within a very short amount of time. So it was actually founded 2008. People were short of money. People were out of jobs. Having access to cheaper deals was a real value creator. So that's the start of a venture boom cycle. Oh my God, we need this category is amazing. We need to go into it. 1.6 billion later, within Shub, take a guess. I know you can look it up, but take a guess. How quickly do you think Groupon IPO'd?
So I don't know this, so I'll just take a random guess. Would they have IPO'd within like 3-4 years?
Very good guess. I had to look it up. It was within 3 years, 9 months. So it IPO'd actually within that time frame for a valuation of 12 point something billion, 12.5, 12.7.
And
right?
this was in 2011, 2012, I'm guessing. It was a
Exactly.
very different ecosystem back then.
It was a very different ecosystem, but it was also the fad, right?
Yeah.
It was the trend. They rode the wave. Today, they are trading at 3% of that values. And it crashed very quickly, actually, after the IPO, as the trend was over and the customers were churning, the customers were moving on. It was not that material to a US or Australian or European consumer to actually have access to daily deals. And to your earlier point, there was dissatisfaction with this. So actually it crashed very, very quickly, very rapidly, 97%. From the IPO price and about 98% from the peak price. So clearly, this wasn't sustaining. Back to the point about the intro here, that was not a substance investment. That was a momentum investment. If you were able to time the exit, and as an IPO, you probably had the chance, then you played the spread very well. So from a financial engineering perspective, there was value creation for those that played the spread, got in early, got out, etc. But those that actually bought at the IPO or those that didn't get out with the IPO, the substance caught up with you, and massively. Because this was a boom investment that was actually a shit business, and we can prove it by the numbers. So this was the 2010 version. Of exactly that. Let's take it to the 2014 version of exactly that. What do you have for me, Shub?
So look, the example that we found, Patrick, is this business called fab.com, which, back in the day was, another consumer e-commerce play. I remember, I think sometime in either 2013 or 2014, when I was doing an exercise back then, this is the earliest days, when I was looking to break into the VC trade, and was doing an analysis of, which unicorns are out there, and who an unnamed investor who's a big unicorn enthusiast, right? What sort of bets they might place, right? So Fab.com had come in my radar back then. So they also had this model of luxury goods, combined with some sort of sampling aspect to aspirational e-commerce for consumers. I think the high level thesis at that point was incomes are rapidly rising. More and more folks want to participate in aspirational brands and so on. And the thesis was that is what needs to uh, you know uh, be an independent category of its own. I think from what I recall, eventually the company I think is completely it sold in a fire sale.
Yeah. And actually, that was the whole business. It actually, sorry, this was such a great pun. I have to say, Shub, sorry. I mean, isn't it sort of cosmically ironic that the company literally built a business doing fire sales of stuff and ended in a fire sale?
Well done, sir. Well done.
Yeah. So the fire sale was 15 million, was sold to another company, PCH, for 15 million. It was a unicorn. It had raised a ton of money. Fun fact, actually, which I did not know just by researching it. Do you know how it originally started before it pivoted to flash sales of design products?
I don't. You'll have to educate me.
Dude, this is like founders riding two boom cycles at once. So if you wanted to rebuild Facebook with a niche community, this is what you would do. And what actually fab.com originally was, it started as a gay social network.
Oh.
Yeah. And then they pivoted into, you know what? Deals, brother. Let's go deals. And so they went into flash sales of design products, and venture enabled them. So this company was founded either 2010 or 2011. Groupon had seen massive growth. So now what's the next thing? Okay, let's go into this boom cycle. Gay social network, too small market, or whatever the reason was. Let's go now into this boom cycle. And they pivoted there, grew fast, etc. Well, we know now how it ended. Why? It was a shit business. There were not enough margins in there. It was huge operational complexity in this kind of a business. And ultimately, the market size for this, as well as the ability to actually control churn, was just not very good in this kind of a business. Immense competition. There were practically no defensibility, no network effects, nothing in this business, so that ultimately it was sold for 15 million after raising hundreds of millions. I mean, I can look it up right now. I actually don't know how much, unless you know. Let me see. Yeah, 340 million raised. Yeah.
Which again, look, we're talking about a time more than a decade ago. It was a lot of money for a venture-backed company to raise at that point.
Yeah, and it had a lot of like very large investors on the cap table.
What do you think? Small tangent here, or maybe it's not really a tangent. Maybe it's the core point. I think what at that point of time, we're talking circa 2012, 13, etc. What were the investors? What did they like about it, or how did they rationalize continuing to invest in fab.com at that point of time?
E-commerce, consumer, fast growth. I think that's literally it. Take my money and oh my God, you're amazing at marketing. You're amazing at building a brand. I mean, does it remind you of anything right now?
I think it reminds me of every super cycle. Isn't that interesting? I think when you think about it, it's incredible how themes change, but the patterns are so similar. In the sense, the super cycle that folks get excited about, it eventually plays out with some extremely well executed large winner.
Yep.
But if you were to treat that as an ETF, that ETF at that point is probably not going to do well.
Terribly.
Right? Yeah. So like 95% of the companies will just be complete write-offs. So it's also important that you don't invest in a company for the theme, as you rightly said, because the theme, even if it plays out, it matters that you are in the right company executing on that theme.
So look, I can agree with that, but I will point out, I think it's more than execution, because literally your company's model fundamentally has to be a working business. And if it's only working because of the boom, it's a shit business. It doesn't matter who the team is. The team of Groupon must have been absolutely stellar. The team of fab.com must have been very, very good. Otherwise, they would have not unlocked this kind of a funding. But if your model is shit and only works in boom times, it will not sustain. It doesn't matter who the team is.
Yeah.
And I think that's something that venture actually fools itself. Venture is all about, hey, let's find the right the right founders, and then everything else will fall into place. No, it does not. Now, can you build an outlier without the right team? No. So it's correct that we obsess with founders, but you cannot make the reverse engineered argument. You cannot say, hey, just because it's great founders, it will also be a great business. No, actually, most of them are shit. And for anyone reading or listening to this, Go back to our episode about actually where we speak. What is the graduation rate from unicorn to decacorn? Compounding is very, very difficult. And that has to do with the market you're in, the model that you have chosen, the compounding modes that you actually build into your business. And very few companies do that. And unfortunately, boom cycles do not foster it because boom cycles ignore all of that. Boom cycles give you money to grow.
Mm-hmm. Yeah. 100%.
So that was the 2014-ish version. We have one a few years later, company called Homejoy. I think you're more familiar with that one as I am. Why don't you take this one? I'll take the next one.
Yeah, so I think, Homejoy, for those of you not familiar, was kind of like the handyman or errands on demand sort of service to do various activities at home that you typically get blue collar work for, cleaning, handiwork, etc. I remember that when I started in VC, it was one of the hottest models you could copy, right? It was one of the easiest businesses that you could start in order to get funding, not to execute, mind you. It's a very hard business to execute, but it was a very easy business model to quickly raise seed and Series A money around the world, right? And very early when I started, a lot of firms used to also call themselves Homejoy for X, Homejoy for Y, right? So that's how deeply ingrained it was in the VC community and the founder community in being considered like a model worth copying. And I think the moment I say this, I think I'm already, I guess, paraphrasing what you said by starting at the start of this episode, Patrick. If the whole premise of something, if it is deeply accepted as a consensus view, that one of the easiest things you could do to get funding is just call yourself a Homejoy for X. That means you're already abstracted so many layers away from reality. The story is completely on extrinsics, nothing to do with intrinsics. It's a recipe for disaster. The reality is, for those of you, for anyone who pauses to think about it, it's a model which needs very deep hyperlocal execution strengths. You need density on the blue collar workforce side. You need high quality service delivery because you're talking about blue collar work entering people's homes, right? So you cannot, there's a very fine tolerance level that is acceptable in terms of how many mistakes or what kinds of mistakes can be done before a business like that implodes. And look, for most businesses, that is a very tough bar to clear. And clearly, Homejoy also didn't deliver to it. And I think most other businesses that copied it also didn't end up well either.
And the boom cycle here, actually, so it's funny that you say Homejoy for X. You know how the company branded itself. It was Uber for professional services.
Yeah.
Founded in 2010, Uber had seen extremely fast growth the 2 years before. So now we wanted Uber for X for for the next, I don't know, still 8 years, I think. After 2010, we saw Uber for X. Same thing here. So the company didn't raise and burn as much as the other two examples that we have. So it's representative of that Uber for X, and we can probably find even more high profile boom and bust examples of this. But again, just because you're riding on a boom cycle doesn't mean you're a great business. So here, clearly, it was not for the reasons that you just mentioned. It was just not a good business. Although it was very easy to raise money for a while. How could we do this discussion and this list without the OG or the eventual OG, maybe WeWork? So WeWork, ultimately, I would describe the business as this, Shub. So WeWork ultimately was a real estate company that wanted to tell a story of community and love, and hey, here's software with which you can feel belonging to your fellow co-workers, although they are not even in your business. It was still, I would say, born out of a gig economy and the point of, okay, everybody's becoming a freelancer, and the traditional barriers of organizations, they will blur and they will break up. We're moving into this almost meditative state of work as a belonging, and we're creating the spaces for all of that. Underneath of that, it took leases in many cities and it broke down the re-rental model into smaller and smaller spaces where per square meter the rent is actually ridiculous and outrageous. So it did have, at a full utilization, it would have always had great gross margins. Unfortunately, it just didn't have good utilization. And so that way you have actually created a real estate business that accumulated a huge amount of fixed cost that you couldn't get rid of. You internalized that utilization risk. Two components that actually are like in businesses, but it missed the final component. It was unable to then sell it as variable cost. So variable cost selling would have been, okay, you know what? The more money you make in your business using my spaces, the more money I make with you. No, it basically just resold on a fixed fee, because that's how the rental model works, right?
Yeah.
But then if you don't master the utilization, which WeWork didn't, you're actually going to crumble. And so ultimately, the company reached an IPO at a 47 billion valuation, completely crashed and burned, shut down, delisted, went bankrupt. It did certainly make one person very rich in that business. Again, a momentum investment that did work out if you actually rode the wave at a good entry point and you exited at the right point. So if you're in style as momentum investing, from a financial perspective, this can have been a success for you. From a sustainable value creation perspective, completely shit business, fundamentally not working. And another example of, hey, this is kind of a boomy thing, the gig economy, and here's this guy that is telling us how this future is going to look. Let's all pile in into this kind of a model, but fundamentally it was exposed as not a good business once the boom stopped.
Yeah. I think for those of you who haven't watched the Apple TV show We Crashed, I think it's worth watching it. I have no idea how much of it is fact, how much of it is creative liberty, but at the very least, it gave me an interesting perspective of what things might have been. And I think assuming, say half of what is presented in that show is true, and I think it's reasonable to assume that based on the externalities, it's also, Patrick, an interesting convergence of what the world was like at that time. So if you circle back to 2018, 2019, which was when WeWork was at its peak valuation, you're talking about a time when Apple has zoomed up to the highest valuation ever. Uber is about to go public. There's a few other Chinese companies about to go public at 100 billion plus. We have the Vision Fund, of course, right? A completely new paradigm in venture, never before seen, and dare I say,
100 billion.
never since seen, by the way, as well. Right? We still have never seen a VC fund that large, or quote unquote VC fund that large, right? So you have this perfect storm of things where the belief is, hey, you can ride a great founder or a great leader to any outcome size. There is no limit to how large VC funds can become. And as you rightly pointed out, the gig economy or the sharing economy is the next big thing. And I think it was one of those companies, or perhaps the poster child company, which like perfectly got swept up in that storm. And I think in that sense, it also fits the description of something which works only when the confluence of these things come together.
Yeah, I think you're right. WeWork was founded in 2010. Again, actually sharing economy. Thanks for mentioning that, Shub. Is the other boom that they rode. And let's just get the numbers right. So raised 13 billion in equity, 1.3 bankrupt. Yep. All right, we got one more here as the.
Actually, Patrick, instead of this example, you think the more fun example might be what we saw during COVID, the virtual.
Oh yeah, let's go. Yeah, I know exactly. Go for it.
Yeah. So, I mean, look, I was about to say, hey, remember the thing that happened recently, but it was 6 years ago, dude. So time flies. So remember that time when, we all couldn't step out of homes, and Zoom and audio visual thing was the only way we communicated. I didn't mind it either, right? And we were like, oh my God, this externality happened, and when will life become normal? And that's when I think I remember, Patrick, there was this narrative that, now things will never be the same again. And there was this cohort of companies getting back.
You're right.
Some including in construction tech, where, hey, it'll never be the same again. Now we have to back all these solutions where everyone is in their home. People never get together at all, right? And that's the future of events. That's the future of getting together. That's the future of human interaction. That's the future of even all social interaction, by the way. And there were these audio-visual conferencing and team get-together and meeting virtual thing solutions. They were raising. I think each of these, I think, had a place, I suppose, in a pandemic stricken world. But I remember even back then, Patrick, when you and I used to chat about these kinds of solutions, we were like, hey, is it really a long-term solution? Is this really something which will sustain itself for any length of time whatsoever? Forget about a single VC fund cycle, but any length of time. And we always used to find it crazy. Some firms in particular, they raise like, I would call it astronomical sums of money, in less than a year. And even while pandemic restrictions are easing, there's like just more and more money being raised. Up. I think taking it up until 15 billion or so valuation, if I'm not mistaken, Patrick. In the case of Hopin, which was
1.5? Was it that much? So I know it was a unicorn. I'm not sure it was a decacorn.
Good question. Let me check. Maybe it was 7-8 billion. Okay, they had got to a peak of 8 billion. So I need to correct myself. But 8 billion, right? Think back to how long each of us was actually restricted because of the pandemic, and a company started in that time and got to 8 billion valuation in that time, Patrick.
It raised 1 billion and sold for 15 million. All of that in this time frame.
Yeah. Isn't that insane? So
I have also, because people might now think, oh, but Zoom. Yep, you're right. Zoom was the eventual winner, but let me tell you what winning means like. So Zoom was late 2019, so end of December 2019 sorry, I'm looking at the euro chart, but just at whatever it is in US dollar, at 60 euro stock price. COVID hit the Western world. And over the course of 2020, the next 10 months, it zoomed to 477.
Wow.
Okay, so what's that? Like a 8x?
Yeah.
And from there, steadily down, sustained that value for another year and a half roughly. And today it is at 76. So a compounded average growth rate from right before COVID to today of 3.5% per year. That's pretty shit. Your S&P index will actually perform much better over that time frame. It's pretty poor. So even the winner has performed poorly.
Mm-hmm. Yeah, and there's an argument perhaps that the winner is not even Zoom, it's the likes of Google and Microsoft
Teams.
Yeah,
you're exactly right.
Yeah.
So, I'm glad you mentioned that. That was another very recent fad. So what's the current version of that? We'll leave it up to everyone's imagination. I think this is the point, right? If your business only... Now, I think that's something that cannot be said about Zoom. So Zoom also works outside of the boom cycle. It was just amplified by it. But its competitors that came up, the likes of Hopin, that only worked because of the boom, and it immediately crashed when the boom went away. What's the today's version of that? We'll leave that to everyone's imagination. Yeah, but I'm just saying, research negative gross margins, which get brushed over because there's insane user and ARR growth. Or let's say rather annualized MRR.
Yes.
Yes. All right, sir. Good chat.
I liked it, sir.
Cheers.
Cheers. Thank you.